Hello and welcome to another episode of Selling Life Annuities. I'm Steve Allison, Annuity Specialist here at Gordon Marketing. And with me today I have my colleague and good friend Tim Luby. He's our National Annuity Sales Director here at Gordon as well. Today we're going to be talking about some of the retirement growth opportunities that people have with annuities. There's a lot of choices out there that can factor in. But why don't we start with, what do you mean by growth in these annuities?
Yeah, good question. Yes. So, growth. So annuities are designed to build up and distribute retirement income. Mm-hmm. And when we're talking about growth today, we're really focused largely on that build up, on that accumulation phase of annuities. So growing up, we might associate that with slightly younger people, mm-hmm. People that might have a little bit of time. They're not quite within striking distance yet of turning retirement income on. So they're still trying to grow or accumulate that retirement nest egg. Right. That's kind of what we're talking about for growth, as opposed to like distribution or annuitization or income.
Yeah, that makes a lot of sense, right? Because if someone's in their 40s, they're not really looking towards starting income now. They probably have another 20, 25 years to think about starting taking income. So growth really has to be on their mind. So what are some of the different types of annuities that they may focus on?
That's a good question. So when we think about it in the growth category, we're talking about fixed annuities today, no variables or anything like that. So everything has, guarantees in it. None of it is subject to market losses or anything like that. So on the top of the list from an accumulation standpoint or growth standpoint would be a MYGA, a multi-year guaranteed annuity. And we like those an awful lot. They probably have the broadest appeal among agents and clients because of their simplicity. They're a lot like a CD at a bank, and a lot of clients understand that. They're also very straightforward. It's a rate guaranteed for as long as the surrender charge is. So a 5-year rate on a 5-year surrender charge. So there's a great deal of certainty and simplicity about getting just a 5.5% rate guaranteed for 5 years. At the end of that time, you're free to leave. So very certain, very simple, and very easily understood.
Yeah. So that's got to be the most, like you said, the simplest one. But there's maybe a little bit more of a complex option that may get maybe a better return. Those fixed index annuities might do a little better.
It can, yes. You talked about fixed index annuities, or FIAs, which we do a lot of. And FIAs get a little bit more complicated than the MYGA. Yeah. But very often they're the right solution for a lot of clients. Sure. Depending again on their age and their timing and their ability to understand an FIA. I mean, no one should buy anything they really don't understand. Right. And so if you can't understand to some degree what you're buying and feel comfortable with your agent's recommendation about that, then you really ought not to buy it. Yeah. So fixed index annuities are interesting. What we like a lot about fixed index annuities now is the durations have changed an awful lot. It used to be that many of them had very long, high surrender charge periods and that kind of thing. We've got FIAs as short as 3 years now. And we probably sell almost as much 5-year fixed index annuity today as we do in 10 years, at least with some of the carriers anyway that we're working with. 10 years for a very long time was our longest duration. Of course, their surrender charge is longer than that. We probably don't go past 10 years too often, but we do. There are opportunities for bonuses and other things like that might warrant a little bit longer surrender charge than you might otherwise see. So, various surrender charges on fixed index annuities is one thing that we would pay attention to. And then when you're talking fixed indexed annuities, one of the things that's sort of complicated, if you will, or that will be important for an agent and a client to be able to understand is how's the crediting work? And that's the big differentiator on a MYGA or a straight fixed annuity and a fixed indexed annuity is how they determine what the interest credit is to the account. Right. And we could probably spend a minute talking about some of the most popular strategies out there. I believe the two most popular strategies would be a cap rate and a participation rate.
Yeah. So those two definitely are the most common ones. They even sometimes come with a fixed rate, but they typically don't match what a multi-year guarantee annuity can guarantee them. But you kind of hinted on it maybe a little bit, but these fixed index annuities have kind of gotten better or revamped lately over the past handful of years. So they're offering more participation rates instead of just only caps.
And you say participation rates, and we're in the industry, so we understand what we're talking about. Right. But let's take a minute and sort of simplify things a little bit, and let's talk about what a cap is, how cap works, and a participation rate and how a participation rate works.
Yeah.
Right. So a cap, it's just what it says. It's a cap on your earnings. Yeah. So you can get what the index does up to the cap. Mm-hmm. So if you have a 5% cap and the index does 2%, you'd get 2%. Yep. If it does 7%, you'd hit the cap of 5% and you get 5%. Yep. And if it does 20%, you'd hit the cap of 5% and get 5%. Yep. So that's the cap rate. It's probably the oldest, most popular strategy that's been around for a very long time. Mm-hmm. One that's being used a lot more today, and we call it an uncapped strategy. It's one of several uncapped strategies that are out there, but it's a straight participation rate. And what that would be is a participation rate. Maybe it's 50%, maybe it's 100%. Some cases it's 200%. And it's 100% of whatever the index is. So if that index does 10% in a given year and you have an 80% participation rate, you'd be credited with 8%. And if it did 10% and you had a 200% participation rate, you'd be credited with 20%. So participation rates vary an awful lot, and a lot of people like those these days because they have the idea that it's not capped, that it's not limited. Mm-hmm. So that's kind of interesting.
Yep. So, those I really like those uncapped par rates. The idea that, especially if their growth is their motivation, then that's just the way that more people are looking towards. Are there any that may offer a higher way of getting a cap?
That's a good question. The annuity industry continues to be innovative. Mm-hmm. It's been really highly innovative. And when I look at some of the things that we're selling today and how different they are from things that were available just a few short years ago, it's pretty incredible. A couple of the most recent innovations that I think really make a difference in the fixed index annuity market today. One of it is specifically as you talk about caps and par rates, for example, is an opportunity for a fee to buy a higher cap or par rate. And that's kind of new. And I kind of like it. It's not right for every client, but for a lot of clients, especially younger people that sort of understand the risk, if you will, or the cost, if you will, of that, that could be a terrific opportunity to have an opportunity for a higher cap rate or participation rate. So that can be very good. A common fee for that might be 1.25%, 1 to 1.25% that they pay in exchange for a participation rate that might go from 50% to 75% or 100% to 150%, hypothetically. So that's an example of what the fees are. One of the other innovations that I've seen more recently that I think is really unique. Fixed index annuities illustrate really well today. And so it's critically important that you manage a client's expectations about what they might actually get. And one of the reasons that the illustrations look so good today is because there's two things that are in there. One is based on historical index performance. So it's historical market and the performance of the indexes behind those. And the other thing is the rates, the cap rate or the participation rate that's in the illustration that's assumed to be there for the whole duration of the surrender charge, we say. And so one of the things that's new is that we've got a number of carriers now that are guaranteeing the cap rates or participation rates for the whole duration of the surrender charge, which takes one of two significant variables out of the equation. Mm-hmm. If you're getting a 150 or 200% participation rate, and now you know that even 7 or 8 years into your 10-year surrender charge, you're still going to be getting 150 or 200% on that, that's really reassuring. And it takes a significant variable off the table. Yeah. As I talked about innovation, the last thing I think, we won't go into a lot of detail on this because there's so many things out there, but the indexes themselves, there's a lot of volatility control indexes. Most of the indexes that are sold in indexed annuities now are proprietary indexes just to that company, just for that product. And the performance on those and the returns that they can provide have really gotten outstanding. Mm-hmm.
Well, so let's talk about the last topic that we wanted to touch base on today when it comes to growth is bonuses. They come into play in certain circumstances. Some people, that's all they hear, the bonus, and that's all they want to focus on. And so tell me a little about how those fit in.
Yeah, that's a great question, Steve. So bonuses are kind of back in a pretty grand way. They've been around for a very long time, but they kind of backed off of the industry, sort of backed off bonuses for a little while, but they're back now and better than ever. And so it's not uncommon for you to see a 5, 7, 10% bonus available on a lot of products with no fee or charge at all. And a bonus provides just a great deal of certainty, something where someone says, I can put in $100,000 today and I can get a 10% bonus, so a $10,000 bonus right now. And that provides a tremendous amount of certainty for that client. that no matter what the annuity does, they know from day one, no matter what, that they'll get 10% on that, which is interesting. So now when I say no matter what, there are often, surrender charge periods and even bonus recapture periods that could affect it if they get out early. But if they stay in for the term, that bonus is good for them. The bonuses can be significantly higher than that too if they're willing to pay a fee. So I talked about bonuses up to 10%. I believe there's bonuses up to 25% on growth opportunities that if you're willing to participate to some degree with a fee on those. So bonuses, annuities have gotten much better, and they can be very appealing because of the certainty they provide in terms of someone having a great return on their index annuity from day one. But the only other thing, and we talk about this from time to time, you also recognize that you don't get something for nothing. So to some degree, if you get a bonus, you might experience a lower crediting rate on the annuity year in and year out than you would for the product, a similar product without the bonus.
Okay. Well, just the guarantee of knowing that they have a bonus is something that can be very attractive. Well, thanks for going over some of these different opportunities with me, Tim, on these growth opportunities for these clients of ours that are going to be interested in annuities. But for that, we're running out of time in this episode. So, if you need to reach Tim Luby, why don't you tell them how they can get a hold of you?
Yeah, my email address is timl@gordonmarketing.com, and my direct number is 330-283-6140.
Yep. And if you need to get a hold of me, I'm an extension 140. Email address is sallison@gordonmarketing.com. And with that, make sure you subscribe to the channel. Hit the notification bell so you can get notification every time we put out a new video. Make sure you like, comment, and share. And with that, happy selling.